Okay, let's see one by one. Okay. William pay 500 in cash to Sonia for the rent. That means this is the tenant. This is the owner. Okay. How did Sonia record? Sonia, this is an income to Sonia. Income to Sonia means that rent receivable. Rent receivable. So now Sonia received money. Okay, receive cash. Sonia received cash means cash account must be debit side. Whereas rent income account, rent receivable is an income account. So since cash received, then here must be credit. So debit cash, credit rent receivable. Okay. Let's say example, the question from the William point of view. If we talk from the William point of view, then in this case, cash tenant giving out the money. So cash will be credit side. And here we didn't call rent receivable, we call rent payable, which is the expenses. So this is from William point, this is from Sonia point. Okay, next. Abdul buy all his machinery on credit. He provide the following information. Machine at cost 30,000, 42,000. This is a balance breakdown. This is a balance CD. Amount owed to supplier of machinery 10,000. Okay. During the year, Abdul paid 25,000 to supplier of his machinery. How much did he owe? Okay, we see the machinery account first. Machinery account beginning of the year 30,000. End of the year 42,000. And he's bought the machine on credit. That means there is a new purchase, which is 12,000. This 12,000 from the supplier point of view. Supplier is other payable for this one. So this one, we will get 12,000 sitting in here. But because here is opening means that this one 19,000 sitting here is a liability. This is a supplier. So debit and credit. Now we have total 31,000. And during the year, Ahmad paid 25,000. 25,000 means sitting in here. Okay, so take 31 minus 29. We should get 6,000. So still have balance 6,000 owing. Okay, next. Hashina buy radio from Nazim at a list price $10 each. Hashina bought 12 radio and was offered 20% trade discount. Trade discount means that this list price, the actual price is only 80%. So times 80%, so it's $8. Okay. This one no accounting recording trade discount. Cash discount is when you make payment. So two radio was 240 and will return to Nazin. What was the total credit notes? Credit note is to record these 2 units. So we take 2 units times the $8, the net amount. Okay, so we get 16. So the answer should be 16. Next is that on question 8. Which statement about the 3-column cash book is cash book? 3 column, you have bank, you have cash, you have discount. Discount, allowed, cash, and bank. Here, credit side, you have discount, receive, cash, and bank. Which statement is 3 column is correct? It contains ledger account for bank and the cash. Yes, only refer to these two for the ledger. Discount allowed, discount received. End of the month, this one will transfer to general ledger. It contains the ledger account for the discount allowed and discount received. So as I say that end of the month, these two amount, discount allowed, discount received, will transfer to the discount and under the general ledger. You will open another account called discount allowed, discount received and put into here. It will not put into this one. This is just a summary of the total. It record transaction before they are recorded in the ledger. Means that all this amount debit and credit in here. After we record, then we will go to other ledger for the recording. Okay. Next, okay, this one is correct. No need. So your answer should be B. Next is question 10. Which error is an error of original entry? You have 6 error. Commission, omission, and then complete reversal, and then what else? Principal, and then 1, 2, 3, 4, and then compensating, and then last original. Commission is that same class, same group of the account, but wrong account. See, correct side, correct class, but wrong account. Omission, totally no recording, no debit, no credit. Complete reversal means that debit become credit, credit become debit. That is complete reversal. Correct account. Principle is that supposed to be expenses you go to record under non-current asset. This is a wrong class. Correct amount, but wrong class. Compensating means that there are at least two error offset each other, the error. Debit and credit offset each other, minimum 2 error. Original entry means that when we first do the recording in the book of entry, already make a mistake. So in the list here, which one is the original entry? Sales of the surplus office equipment on credit to Janet for 2-3 enter as in both disposal account. So this one, first recording already make a mistake. This is the original entry, okay, which is supposed to answer. B, sales of surplus office equipment on credit to Janet to enter in the office account and Jason account. So in here, we have sales of this entry. We on credit to, we suppose debit Janet, and then disposal account credit. This two double entry, but we make a mistake. We go to enter in the office equipment account and Jason account. That means we put Jason and then here we put office equipment account. We do this double entry. So this one actually is a wrong person. Okay, wrong class. Wrong account. Same group, wrong account. But these two also the wrong one. So this is totally I will say this one is a commission because this is also this wrong, but this is also wrong class, wrong account. So basically this is totally account also wrong. So we have to reverse this totally and then put back the correct one. Sales of the surplus office equipment on credit to Jeanette. Enter in the sales account. So sales account and the disposal account. This is a disposal account. But we go and put into the sales account. This is a wrong class account. Okay. Sales of the surplus office equipment on credit to Jeanette. Not enter any. That means this is an omission. They didn't debit, they didn't credit. So this is omission. So the answer should be A. Okay, next. Okay. 14. Jerry's sales ledger control account has a debit balance, 12,000. Okay, so sales ledger control account, we have 1200 in the debit side. Interest on overdue account, that means we charge the customer $40. And discount allowed is in the credit side, has been omitted. So we put in here 150. What was the correct balance on the sales? So we debit and then we credit. So the new balances will be debit minus credit, 1200 plus 40 minus 150. 12 minus. So we get 11890. So the answer should be B. Okay. Which statement about the capital expenditure? Capital expenditure is like purchase of the non-current asset, extension of the non-current asset, improvement of the non-current asset, additional capital, borrow the bank loan. All these consider capital expenditure. It is the money spent on the day. The day-to-day, this is a revenue expenditure. It is the money spent on the purchase of, yes, one of it under capital expenditure, purchase of non-current asset. So this is one of it. It is a record in the statement of financial position. Yes, this one amount recorded in the statement of financial position. And normally is our syllabus is non-current asset a lot. It include expenses related to the non-current expenses. It refer to the revenue expenditure. So the answer should be 2 and 3. Okay, 16. Near sold equipment with net book value 200. The proceed of the sales 250 were credited to the sales account and debited. So by right, when we do the account for the non-current asset disposal, the cost is sitting here, the provision for depreciation sitting in here. And then the sales proceeds should be sitting in here, credit side. And the differences could be in gain or the loss. So based on this information, the net book value means that cost minus provision for depreciation. So we have the net amount 200 in here. The proceed of this one 250 by right should be sitting in here. But we go and make a mistake. We make a sales. We go and credited sales. This one we didn't record it. We put credit sales and then we debit cash book. That means cash book is correct. This one is no wrong. Wrong is this account. We're not supposed to put the sales account. So what was the effect on this error on the near gross profit and the profit for the year? Gross profit is referred to this sales account. This is the sales account. It will affect the gross profit. Okay, so sales, it will increase the gross profit. This one credit means overstate. So this one automatically overstate. So overstate. But the amount is 250. That means this is only the answer. Okay. Next is that profit for the year. Profit for the year is when gross profit overstate. Gross profit overstate. Profit will be overstate by this amount for the sales. But at the same time, for this account, the difference is 200. We will write into the income statement in here 200. Okay. Get it? So this amount will go to, because this disposal, this one, it will be the loss because no recording for this one. So I go to income statement first. So this one, gross profit increase, income statement increase here. And then this one, disposal, this is a loss, 200. This will be the 200. Okay, we omitted. Okay, let's see. We omitted loss, omitted. I mean expenses. This is omission. Expenses understate. Expenses understate. Profit will be overstate by 200. So that means this one, profit overstate by 200. Okay. So that means this is refer to this one. This one, the answer should be C, because for the gross profit is only one, which is 250. The answer should be C. Okay, let me check. Your answer is correct. C. Okay. Okay, next. Why does a business provide depreciation? The purpose of depreciation is to estimate the loss of the non-current asset over its useful life, so that we know how much that we use to charge into the income statement. So this, to charge the cost of non-current asset or against profit for the year of purchase. Okay, so this one charge the cost. This one is to charge the cost of the usage to ensure that the non-current asset appear on at book value in the statement. Okay, this one is, there's one of the reason we do the depreciation to ensure that the matching principle, okay, matching principle apply in the prepared. This one is more accurate. When talk about the accounting principle, you have for this depreciation, you have two. One is a prudence, one is a matching. Under prudent is that profit and the asset not to overstate. Under matching is that income and expenses match to the each other. So means that your expenses incurred must be matched, must reduce the income in order to get the accurate profit. To retain cash in the business, so this one definitely is not, because this is not the purpose of doing the depreciation. So the answer is more accurate, should be C. Okay, next one. Okay, 19. Why would a bakery business not include a value for inventory of stationery in the statement of financial position? Okay. Okay, stationery. This one, bakery, what they do? They buy the flour, they buy all the ingredient to make the bread. Stationery for them to write, record. So this is more toward expenses. Okay. They say that not include a value of inventory because this one is insignificant. Normally we buy from bakery shop, they won't buy a lot of stationery. This is immaterial. This is under the materiality. The amount is immaterial. Accounting allow us to do the charge out to the expenses. That means we can 100% charge to the expenses rather than keep it as inventory, because this is very low value. Okay. It was expected it will use in the next few months. So this one possible, we will use it in the next few months because we won't buy a lot. Next is that it was purchased regular and pay in cash. Not necessarily pay in cash. We can buy and we can owing the supplier. It was not for resales. This one, correct. This is not for resales. It was a very low value. This question, this all except this one. This all can be possible answer. But why they say that not include as inventory and we charge it out? Because as I say, materiality, under the materiality concept that you can treat it as an asset or what, or charge it out depending on the value. So in stationery for the bakery shop, they are not to buy to sell it. So basically we will treat it as expenses because the value is insignificant, the materiality concept. Okay, next, Shipa financial year end on 30th April. On 31st March 2021, she wrote off debt owed by Tahir. That means the double entry, debit irrecoverable debt and then credit Tahir. From who point out, she means that Shipa will do this recording. She wrote off. So Which entry did, so this is a irrecoverable debt. So debit irrecoverable debt and credit are here. Okay. And then after you could do this recording already, let's say example, you do the irrecoverable debt, you debit in here. End of the year, you have to transfer to the income statement. So your this account close, income statement here will have irrecoverable debt. Okay, next, how should inventory be valued? This sentence, so long as you saw valuation of inventory, key sentence, lower of cost and net realizable value. Always choose the lower. What is meant by the cost? Cost, your cost can be purchase price or additional cost incurred. For example, you buy the goods, you get supplier to deliver you will incur the carriage inward. This is a transport cost. Or maybe the supplier charge you the tax. This is called additional, which is part of the cost. Whereas net realizable value is, for example, you have your this A inventory item, you have 10 unit. And this 10 unit when you bought is a $10. So this $10 total inventory become 100. You can sell it at $12. And in order to sell this $12, that's assuming you able to sell 1,002. But out of this 10 unit, could be 2 unit, there's some of the minor spoil or whatever defect on the item that you bought due to the long term you keep in the warehouse. So in this case, these 2 units, I had to incur some repair costs in order for me to sell at $12. Let's say I need to incur at $4 in order to sell $12. So what will happen is that my calculation for this 2 unit will be 2 unit times, because this $12, 4 minus 4. Now the net realizable value will become $8 only. So in this sentence saying that lower of cost and net realizable value, we should choose the lower. So which one is lower? $8 is lower than the $10, the cost. So I have to take times $8. After that, the balance 8 unit, here, I will times $10. That is what we meant by net realizable value. Okay. Now let's continue. James is an accountant and operates as a sole trader. Which item will appear in his statement of financial position? Statement of financial position, you have 5 sections. Non-current asset, current asset, capital, non-current liability, current liability. So which item not appear? So long-term loan is under here. This is a long-term loan. Okay. Retained earning, this is under the company account. So number 2, it will not appear. Trade payable is under here. This is current liability. So the answer should be C. Okay, next. Okay, 23. Zaha is a consultant who received fee from the client. So consultant don't have inventory. They do the service. Okay. How would Zaha calculate his profit? In this case, when you calculate the income statement, you would take the income minus the expenses because you don't have the inventory. When you don't have inventory, no cost of sales. So either C or D. Since that here put minus expenses, so the answer should be donkey. Okay, next. What is added to the owner capital to calculate the capital employed? Capital employed got 2 components, capital and non-current liability. So here they say that added to owner capital, they are talking about this non-current liability, which is donkey. Okay, 26. N and B is a partner. Share profit and loss equally. They provide the following information. Okay, let me go down first. Okay, the profit sharing is equal. So they say that what was the bank's share of the residual profit? So we need to calculate residual profit first. Profit for the year. Interest have to minus. Drawing, this is not interest on drawing. Don't take these two amount. So take these two minus, so you will get 11,000. So 11,000 share by both. So we get 1 divided by. So 5,005. So the answer should be A. Okay, next. Which statement about a receipt and payment account is incorrect? So receipt and payment account is a club topic. Okay, incorrect is wrong. This is receipt and payment is just like a bank account or cash book. It include amount prepaid. Yes, in the credit side, you have prepaid for the expenses that you pay. Next is that, no, this one is end of the year. Yeah, this one is in the credit side. Sorry. Next is that it show a surplus. Surplus is under the income and expenditure. Which when you prepare income, then you less expenditure, then you will get the surplus or loss or deficit. So that is for the club. Whereas non-monetary item are excluded. Non-monetary is like example the depreciation. So excluded, that means this is correct. The balance represent the cash and bank balance. Yes, this account is actually cash and bank account. But this one prepare yearly, this one prepare monthly. Okay, so all these three items is correct, except the B surplus is referred to income and expenditure. Okay, 28. How does a manufacturing calculate the prime cost? The prime cost got three components. Prime cost, raw material, and then direct debit, direct labor. Normally it's a worker work in the factory, and then direct expenses. Okay, so in the list in here, direct material, which is this one. Direct labor is this one. Direct expenses is this one. This one they add into here. If they add into here, this one become cost of production. We add the factory overhead, that will become cost of production. So next, this one is no. This is the wrong. So basically, the answer should be B. Okay, next is that NOLA provide the following information for the year ended 31st March 2021. Drawing net asset at. So this is the opening balance. Okay, this is closing balance. So we open the T account for capital. Okay, net asset is equal to capital. So capital account. So drawing is in here, 3900. Net asset 1st April. That means this is a balance BD, 60,500. Whereas this one, and net asset 72275. So this total debit, let me count, 3900 plus 72275. And then minus 60. The amount is 15675. So if this is the amount in the credit side, this is a profit. If in the debit side, it's a losses. So you have profit. So amount 15675. Okay. Now next is that This one I think is repeated. It was found that the closing inventory should has been okay. I think this is a repeated question. If I'm not mistaken. Yesterday we discussed already. Okay, let's explain. Normally, most of the time I'm not 100%. This paper I think is paper 3, variance 3. Okay, when you want to do the passive question, most of the time, variance 3 is follow either variance 11, variance 1 or variance 2. So when you want to do passive question, don't take this variance 13. Try to do it good enough. Most of the time, this 13 follow 11 or 12. That means this one we discussed already. So I skip it.
Okay.
Let's give me a minute. I find the file. Okay, let's see. Okay. The basic accounting equation. Okay. The basic accounting equation is that asset equal liability plus capital or capital plus liability. Okay. Sometimes the question will change to capital equal asset minus liability. This one also can. Or liability asset minus capital. These all are the correct accounting equation. So in the list in here, asset equal, this is minus. So minus is wrong. Asset equal, this is minus also. This is also wrong. Asset minus liability equal to capital. So this is the answer for it. Okay. Now next is Jabari maintain a petty cash flow using impress system. Impress system means that the same amount at the beginning of the month. The impress is stored at the end of each month. Which amount we store the impress at the end of a month? So let's say you have a T account for the petty cash flow, and you already spent for last day, let's say 31st, your balance CD, you left with $10. Your impress amount, let's say, is 200. That means you already spent for 190. So you get 200. Okay. And this amount will bring it here, become first opening $10. And the question saying that end of the month they restore. That means in here, they will add another restore amount, which is bank here. And then here we'll put 190. When they put 190, the new balance here become 200. It will become 200 in the following month. That is what they call restore. So they say that which amount restore the impress at end of the month. The amount left in petty cash less the total voucher received. Voucher is referred to the payment voucher for this one. Okay. The amount left in the petty cash plus the pay. This voucher is referred to the credit side of the payment. The impressed amount less the total voucher rate. The impressed amount means that this 200 less the total of the voucher received. That means the payment made. Okay. Next is that the total of the voucher received. The question is that you see the amount that I putting in, I top out. I do the top out is in here. Yeah. This is the amount that I do the top up in order to get back the 200. So means that my total amount restored is equal to the total of the voucher receipt.
Okay.
So far, okay?
Yeah.
Okay, now 9. Just now we already go through the 6th error. So 6 error you need to memorize. We'll come to compensating. Compensating means that minimum 2 error in the accounting record. So which one that consider minimum two error. A payment for office equipment repair was debited. This repair is the expenses, office equipment, non-current asset. This is a principal error. So this is not compensating. A purchase of goods from C. John has credited to the C. John. So this one is a supplier, both different supplier, but under the same class. So this one we call commission, error of commission. Okay, the sales of goods 65 to AZ was entered in the book as this one. When you enter book means that this is a first recording. First recording already make mistake, we call original entry. Next is that the wages account was understated by 100 and the rent account was overstated by 100. That means when you prepare the trial balance, debit and credit, one is short 100, one is extra 100. At the end, no effect. So this is the error that they are talking about. There are more than two errors compensating each other. Okay. Give me a minute. I need to take a break first.
Okay.
After preparing of Abdul draft financial statement, two error discovered. The purchase of machine by bank transfer 5,000 was omitted. That means this omission, we have to debit machinery account and then credit bank. Second, the purchase of motor vehicle 15,000 was entered in the motor vehicle repair. This is an error of principle. So we have to debit motor vehicle credit repair account. Okay, what effect will correcting this error have on the non-current asset and the working capital? Working capital is that current asset minus current liability. So non-current asset, when we correcting the error, we will debit this one, we will debit this one. They mean these two debit means 20,000. It will increase by 20,000. Come to the working capital, current asset minus current liability. So we will credit this one. When this one bank credit, asset, current asset, debit increase, credit decrease. So since we credit, the current asset will decrease by how much? By 5,000. Whereas this one is repair account. Repair account is the expenses account. So nothing to do with this double entry. So in this case, the current asset, working capital, current asset minus current liability. So working capital will decrease by 5,000. So the answer will be C. Okay, next up, 11. Raj has a debit balance of 10,800 in the bank column of his cash book. Cash book. He discovered that the purchase 890 paid by check has been recorded as 980. That means this amount we over recorded 980 minus 890, which is 90. Check means bank. We overstate by 90 here. Okay. The following appear in the bank statement, but has not been entered in the cash book. This overstate. The question, what was the debit balance in the bank column cash book after adjusting this error? This overstate, we have to reverse out, which is we need to debit in order to reduce this overstate amount. So debit in here, this one, debit to reverse the error, to reduce the overstate amount. And then bank charge 76, we have to pay out. Interest received is our income, so 120. So take the total debit minus the credit, 10800 plus 90 plus 120 minus 76. So the answer should be 10934. No answer. Answer is here. Okay. Next this one correct. 14. The following payment were made by John when he purchased a machine. The question is asking machine account. Means that capital expenditure. We need to identify which one is capital expenditure. Purchase of machinery, delivery charge. When you bring the machine in, this is a charge. So this is one of it. Install. Okay. You saw the insurance, you saw the maintenance. So these all are recurring. So recurring, this is revenue expenditure. So we have to plus these 3 items. So we'll get we'll use 0, 0, 100 at 1, 2, 1. Should be 1, 2, answer C. Okay. Okay, question 15. On 1st Jan, Z enter the cost of repair 42 into repair is expenses, equipment is non-current asset. On 31st, depreciation of 20% per annum using straight line method was charged on the balance of the equipment. What was the overall effect on the book of value of equipment on this one? This one 20%. So I get 84. This is a depreciation. Okay. So I have equipment 420, provision for depreciation 84. So the overall effect, we take this one minus this one, we get the net book value. So the net book value will be 336. So end of the year, our non-current asset will overstate by 336. So overstate. So the amount should be B. Okay. Minus the provision for depreciation, the net amount is this one. Okay, next. Alif depreciate his motor vehicle at the rate of 20% per annum using reducing balance method. On 1st May 2021, Alif owned motor vehicle which cost 35. At that day, the motor vehicle has been depreciated 12,600. What was the balance on the provision for depreciation account on the 1st? So this is the beginning year. Okay, this is a second. Okay, let's calculate first. I want to, my year end will be 30th April 2022. So I want to calculate this year end, my depreciation amount. So I take the cost minus this one, accumulated depreciation, which is the provision for depreciation. And then I times 20%. So I will get 35 minus 126 times 20. So I get 4480. So this 4480 in my provision for depreciation account. So my beginning is balance brought down 1600. Current year 4480. And the question is asking 1st May, which is my this balance CD. These two added up 12600 17 17080. This 1780 will come to here, which is 1st May 2022. Balance brought down. Okay, so answer should be 17080. Okay, the financial year of Yo end at 31st. On 1st April 2021, he purchased machine 4,000. He estimates that it will have a useful life of 3 years and the residue 100. You use the straight line. So with using this straight line formula, it will be the cost minus residual value divided by the useful life. So our cost is 4,000. Residual value is 100. Useful life is for 3 years. So that means 3,900 divided by 3 will be 1300. So the depreciation for 1 year is 1,003. So what was the loss? So the question is that disposal. So we need to prepare the disposal account. The cost is 4,000. And then when the asset was disposed, 2022. So this one, when he bought 2021, that means it's only 1 year. So this 1,003, only 1 year depreciation calculation. So, and how much the sales proceed? The sales proceed was 1,005. 1,005 is a bank amount. Okay, take the debit minus credit because here is 2,800. So 4,000 minus 2,008. So the losses will be 1,002. So the answer should be B. Okay, next up. What is the purpose of preparing a partnership appropriation account? This appropriation account starts from the profit for the year. We plus interest on drawing, less interest on capital, less salary. Then we get the share of the profit. So this is appropriation account. The purpose for us to calculate the share of the profit. So now here to calculate the interest to be charged on the drawing made by each partner. Okay. This one here, this is the part that they are talking. Now next is that the calculate the interest to be paid of the capital invested. So this is the one they're talking. To show amount salary which each partner entitled, which is what they're talking. To show the division of the profit or loss for the year between the partner. This one is talking about share of the profit. So the main purpose of appropriation account to calculate share of the profit. So D is more appropriate. Okay. Next is that Raj and Sim is a partner, 2 and 1. Okay, Raj withdrew 5,000 during the year and was charged interest 3%. Sims did not make any drawing during the year. The profit for the year is 30,000. How much was credited to Raj's current account at the end of the year? We calculate the profit first, the share of the profit. The profit is 30,000. Okay, and then Raj withdraw and charge interest at. So this interest is a interest on drawing. 5,000 times 3. 5,000 times 3%. We get 1,005. No, sorry, 150. So 150 plus 150. So we get 30150. And then after that, there is no other information. So we get this one. This is a plus. We share by 2 and 1. Raj is 2. They're asking for the Raj current account. So take 30150 divided by 3 times 2. So 30150 divided by 3 times 2. So I get 20100. So this 20100, they say that how much was credited? The word credited is sitting in here. This is a debited. Debited amount is this one, current account, 5,000. And the interest, which is 150. Credited amount, which is this one, 20100. Okay, so the amount credited is donkey. You need to careful with the word, the last sentence. This sentence is talking about the credited to. That means they're asking this part only. Sometimes the question may ask you, how much the balance CD? How much the net? So you need to calculate according to the last sentence they want. Okay, this is a keyword, credited. Okay, next up. Question 26. A limited company provide the following information. Total equity first gen, ordinary share, dividend, transfer to total equity. What is the profit? Okay, so we use the equities. What is the plus? What is the minus? So opening, this one, plus. Ordinary share dividend pay, this one had to minus. Transfer to general reserve. Under the statement of change equity, you have 3 columns. Share capital, reserve, general reserve, and the retained earning. Okay, this is general reserve. When they say transfer to general reserve, this one 12,000 will go to here. And then here will minus. So the event, it eventually is a 0. So this is don't take, no effect. Okay. Total equity. Your total equity is end balance. What is the missing? The profit. So profit missing, if we take the 500,000 minus 25,000, the profit is to plus profit equal to 55,800. So my profit will be 55,800 minus 500,000 and plus 25,000. So I will get, let me count, 558 minus 500 plus 25. So total profit is 83,000. Okay, so the answer 83,000 should be C. Okay, next is that question 27. Which group contain only the item of the prime cost? Prime cost got 3 components. Raw material, direct labor, and then also direct expenses. So which one is all item? This depreciation is under factory overhead, so out. Direct wages, which is direct labor. Factory supervisor wages is under factory overhead. So this is also out. This is factory insurance also under factory overhead. Factory overhead out. So no more others. Donkey is our one. So raw material is this one. Royalty fee is direct expenses. Direct labor is direct labor. Donkey. The work in progress of ZT manufacturer on 1st Jan was valued at 6,200. At the end of it valued 54. What was the effect on the cost of production? Under our cost of production, we have the prime cost, which is these 3 components, plus the factory overhead. After that, WIP. This WIP, work in progress. Beginning of the year, opening inventory, closing inventory. So opening inventory is 6,200. And then closing inventory is 5,400. That means we minus, we get 800. So this is opening bigger than the closing. That means this is a positive. When it's positive, your cost of production will increase. So increase by 800. Okay, let's continue. Okay, 29. A trader does not keep all full accounting record, but was able to provide the following information. Opening capital, closing capital, drawing. During the year, 9,500 was withdrawn from the owner private bank. The moment saw the private bank, this is the additional capital. Okay, additional capital. To purchase motor vehicle to be used in the premise. So this double entry will be debit motor vehicle, credit capital. So we open the capital account. Opening capital sitting in here, 2600. Closing capital sitting in here, which is a balance CD. Drawing, debit side. And then this additional capital, 9,000. This is 9,500. This is transfer to motor vehicle. So the balance will be the profit. We take the total debit minus the credit. So let's see. Okay, the answer is 8,000. So the answer should be A. Okay. Next is that a business provide the following information: opening, closing, rate of inventory, turnover. So the formula for this one, cost of sales divided by average inventory. So we have 5 times equal cost of sales. We don't know, but we have this opening inventory and closing inventory. 6,008 plus 6,000 divided by 2. So 6,000 plus 6,800 divided by 2. We get 6,004. Okay, this one bring it to here, become times. So our cost of sales is 5 times 6,400. So we get 32,000. Okay. And the question asks for the purchases. So the formula for the cost of sales is opening inventory plus purchases minus closing inventory. So the amount, 32,000, cost of sales. So opening is 6,800. Purchases, we don't know. Closing inventory is 6,000 equal 32,000. So our purchases will be 32,000 minus opening 6,008. This one minus become plus 6,000. So total will be 32,000 minus 6,008 plus 6,000. So we get purchases is 31200. So the answer should be B. Okay. Okay, next. Okay, question 31. Jerry started his business on 1st Jan with no opening inventory. On 19 April, a fire destroyed all his inventory. Jerry provided the following information for the year to this one. Revenue, purchases. Okay, we use a simple income statement. Revenue minus cost of sales. Cost of sales, opening inventory, purchases minus closing inventory. We get gross profit. The question already said they started business. There is no opening, 0. Revenue is 30,200. Purchases is 25,600. And the gross margin is 25%. Gross margin 25% means that this is 100%. Okay, we find using this information first. This 100 minus cost of sales get 25. That means cost of sales is 75%. 100 minus 25, 75. So using this 75 information, we find the cost of sales. So take cost of sales is 30200 divided by 100. This one set times 75. So we will get let's see, 2 divide 100 times 75. So I get 22,650. So this is the amount cost of sales. They don't have the opening. So 0 plus 25,600. minus closing inventory, we get 22650. Okay. So this minus, I bring it to there. This one will bring it to here. So become 25600 minus 22650 equal closing inventory. So minus, so I get 2950 for the closing inventory. So 2950, the answer should be B. Okay. Okay, next. Okay, 32. A trader provides the following. ROCE. The formula for the ROCE is profit before interest divide capital employed. Capital employed is a capital plus non-current liability. So what information that we have? Profit for the year. They don't talk about the before interest. That means we assume this is the 24,000. Okay. Then our capital is 12,000. And then non-current liability is 30,000. So means that 24,000 plus 15,000 times 100%. So 24 divide 150 times 100. So I get 16%. So the answer should be 16%. Okay, next. Okay, question 35. Which accounting policy require that the information in financial statement is free from the significant error? The moment you saw the free from the error and bias, this is the reliability. Okay, reliability. Consistency, this one is under accounting principle, not under accounting policy. Okay. Now next. Okay, before that, I just explained a bit about this one. Comparability is able to compare using the similarity and the differences to compare the result. Consistency is under the accounting principle. Accounting principle say consistency that the method that we use in the accounting should be continue, not change. Okay, unless the change gives a better view of the account. Understandability is that the presentation or the accounting information, financial statement, able to understand by the user. How we want to ensure the understandability is that we follow the accounting standard. The user have to go to learn themselves what is the accounting standard. This international accounting standard. So that's why this all is under this, except this one is not. Okay. We change to the next page. Okay. Question 2. If the ledger account appear in the leave a trader, so this asks one. Okay, this is all purchases. That means this is a trade payable account. Trade payable account, the debit credit item are more or less are fixed. This discount refer to the discount received. Okay, which statement is correct? Amtra allowed Lee 100 trade discount on 30th. So this is not trade discount. This is called cash discount. Amtra owed Lee 2,100 on 1st April. Who owing who? This one should be Lead owed Amran, not the Amran owed. Next is that Lead owed Amran 2,950 on 30th. This one is referred to this one. This is the correct one. Lead net purchase from Amran in April were 2,009. So if we want to calculate the net purchase in April, we take this one 3,000 minus this purchases return. So the answer should be 2,850. So the answer should be C. Now let's continue. Okay, question 4. Omar sent a credit notes. That means Omar is a supplier or seller. Okay, Miriam is the buyer. Okay, how would Miriam record this transaction? From the buyer point of buyer will record purchases, will record the purchases return, and will record the trade payable. So now Miriam, how to do this? Goods return. Goods return is purchases return. So it will, who received the goods now when he returned? Omar will receive the goods. Purchases return account must be credit. So the answer should be C. Who received the goods when returned? Omar received. When Omar received, debit side. Debit is a receiving. Credit is a giving out. Okay, let's continue. Okay, question 6. A petty cashier received 100 from the cashier, from the chief cashier, and $10 from employee who has made the private call on the business telephone. How would this amount be recorded in the petty cash book and the cash book? So petty cashier received 100. That means debit petty cash book, credit cash or bank, okay, or cash book. This one is for this country. Whereas this one, $10, it will debit petty cash book and credit what we pay for. Private call means that telephone charge. We credit telephone charge, $10. So here, debit petty cash book. How many times we debit? 2 times we debit. Total will be 100 plus 10 is 110. Credit and credit petty cash book. This one nothing to do already, okay? Here debit cash book. Debit cash book is this one, which is 100. Okay, why there is no? Okay. Oh yeah, correct. This one is correct as 0. We should credit. So this one credit, this one debit. So the answer should be donkey. They didn't do this one. This one they ignore it. They just take the petty cash book and the cash book account. So by right, the full double entry is debit petty cash book 110, credit cash book 100, and then another one credit telephone $10. Okay, next move on. Maria draft income statement for the year ended 31st March 2022. Show the profit for the year is this. On the 31st December, Maria received 5% bank loan of 4,008, which was incorrect, treated as a revenue receipt. That means treated as a sales or revenue. In error, a whole year interest on the bank loan was included in the drafted income statement for the year. So this one, what was the correct profit? Okay. This entry will be received debit bank, credit bank loan. By right, we should do that, but we didn't do this one. We go and credit sales. So when we credit sales, so in sales is revenue. Revenue will be increased. Revenue increase, gross profit increase. Gross profit increase, profit will increase. So the amount will be 4,008. Okay, next is that in error, a whole year interest on the bank loan was included in the drafted income statement for the year. That means they are talking about this one. What was the correct profit for the year ended 31st? So this amount, when I reverse my profit, 38750, I have to minus 4,008 because this is not supposed to be in. But don't forget this 5%. How we calculate 5%? We take 4,008 times 5%. So this is the expenses. So calculate first. So the amount interest is 240. At this same time, this is also omitted. This is the expenses. So now we have to put these expenses. So we had to minus 240. So these two minus 238750 minus 4800 minus 240. So we get 33710. So the answer should be, don't have the amount. Where is the thing goes wrong? What was the correct profit for the year ended? In error, a whole year interest was included. Okay, sorry. They already said that this one, they already included this interest. That means don't take this one already. They already counted this one. So that means we only take these two. 38750 minus 4800. So should be 33950. Is there any amount? Also don't have. What happened? There is a mistake. Let me count one more time. In error, a whole year interest on the bank loan was included in the drafted. They mean they treat this one as an income. If this is the income they treated, I need to minus twice. If I minus twice, wait, I'm not correct the amount. 5%, 4,008 times 5, 240. Profit before, what was the correct? In error, a whole year interest on the bank loan. Interest on bank loan was included in the draft for the year. So this one, I already included. Before. What does mean by was included? In error, a whole year interest on the bank loan was included. I mean they treated as an income. If as an income 240, this one, my profit is overstate. I had to reverse the overstate amount, and at the same time I had to reverse this one. Let me count. This total will be 480. So if I put in 480, so will come 38750 minus 4800, and then minus 480. I get 33470. Also don't have this amount. Where's the mistake? Let me count again. So this one is profit before. And oh, sorry. This is the 21. Correct. The financial year. Year ended. That means your financial year is 1st April 21 to 31st March 22. This one, we need to count the period. Your this 1st Feb 21 to 31st March, 31st December 21. From here to here, only 3 months. So the mistake is in here. We calculate the interest, 4,008 times 5%, but we only times 3/12 because only use for 3 months only. Okay, 4,008 times 5 and then times 3 divided by 12. So this is only 60, the interest. So this one we need to take the profit 38750 and then minus this one, the principal amount minus 4,008, and then here they say they already included, so we should put into 60 here. Minus 675 minus 4800 minus 60, so 338. So this one, if they treated as an income, that means we have to, they treated as an income here. So we have to reverse 2 times. So reverse 2 times will be 120. So 120, let me see whether correct or wrong. Minus 120. I get 33830 leh. This is only 3 months. What does it mean? In error, a whole year interest. Oh, okay. I understand what this mean for already. I know what they're talking about now. Okay. What they're trying to say is that this amount, what they recorded is 4,008 times 5%. They calculate the whole year. 4800 times 5, 240. By right, should be 60 only because this is only 3-month usage. So in this case, our expenses are overstate. So 240 minus 60. 240 minus 60. So we get 180. This is the expenses overstated. So we had to adjust this out. So when we adjust this, maybe we need to reduce the expenses. When reduce the expenses, profit will increase. Profit increase means we have to plus it. So we should take this minus and plus this one. 38750 minus 748 plus 180. So the answer should be 341130. So this is how the amount come from. The sentence in here means that they charge this one as a whole expenses. By right, we should charge 3 months only. Okay. Okay for you?
Yeah.
Okay, next. Okay, question 12. Which statement about is reducing balance of is not correct? Reducing balance first year until the last, the value getting lesser and lesser. That is for the reducing balance. A lower amount of depreciation is charged in the early year. So this is wrong. Should be the largest amount charged over the year. This should be wrong. Each year a given percentage is deduction from the cost of the asset lesser. This is correct. That means cost minus provision for depreciation times the percentage. It is used for the asset which given greater benefit in the early year. Yes, this is correct. This is, for example, computer, motor vehicle, machinery. The net book value of the non-current asset will never reach a near. Why? Because your percentage, if you can use calculator, you notice your this one, keep on divide over the period. The value getting lesser and lesser, but it will not reach the zero because you still need to times certain percentage and the value cost. Okay. So this one should be the A, which is the wrong. This one should be greatest because first year is taking the cost times the percentage. So this should be the greatest amount, not the smallest amount. Okay, next. Okay, 19. Okay, Carol and Dennis is a partner. So this one is 2 and 1. Okay, Dennis' current account beginning is debit balance 2000. N is that have a credit balance. I mean balance CD is in here. Balance BD is BD in the credit side. She has made no drawing. That means no drawing in here. What was the total profit made by the partnership in the year ended 30th April 2020? So from here to here, this is no differences. How much this total debit side? 9,000. So this one 9,000 sitting in here. Get it? This is a profit share. Okay. The question is asking that total profit made by the partnership. Then Danish is get 1%, one portion of it out of the 3 portion. Total is 3 portion. Danish get 1 portion, and this 1 portion equal to 9,000. It means two portion will be 2 times 9, 18,000. So the total profit will be plus together. 18 plus 9, 27. So the answer should be donkey. Next, question 20. Which statement are correct? A debenture holder of a limited company is liable for the debt of the company. This one should be the shareholder, okay, not debenture holder. A partner is liable to pay business debt from personal asset. Yes, because under sole trader and the partnership, we have unlimited liability. Personal belonging can be taken away. A shareholder of a limited company is responsible for the company debt. This is not responsible because we have limited liability for the company. A sole trader is responsible for all the debt of yes, because he's the only person. So everything he has to bear for it. So the answer should be 2 and 4. This should be C. Okay, 21. The draft financial statement of a limited company show retained earning 31,820. It was then found that no adjustment had been made for the commission receivable accrued. Commission receivable accrued should be debit other receivable, which is this is a current asset. And then credit commission receivable. When we credit commission receivable, income increase. Okay, when income increase, profit will increase. So what is the question they ask? What was the correct amount of the retained earning? So means that I have to plus 450 to this draft income statement, this retained earning. Insurance prepaid. Insurance prepaid, I have to take debit other receivable, credit insurance. When I credit insurance, insurance is expenses. Credit insurance, expenses decrease. When expenses decrease, profit will increase. So this one also had to plus. So I had to take these 3 amount plus together. So 31820 plus 450 plus 175. So we will get 32445. Okay, we move on to the next. Okay, 22. Which statement about the club account is correct? Capital and revenue transaction are recorded in the income and expenditure. Capital transaction means the purchase of the non-current asset. This one we don't put in. Non-current, non-cash transactions are recorded in the income. Yes, this one refers to our depreciation. And this is under the expenditure. Okay. Next is that only revenue transactions are recorded in the receipt and payment. Revenue and capital transaction record in the receipt and payment means that bank account and cash account. Debit and credit side can be the non-current asset transaction. So this one is out. Next is that the closing balance in the receipt and payment account represent a surplus, not the receipt and payment. It's the income and expenditure represent the surplus or deficit. So this is wrong. So the answer should be B. Okay. 23. A sport club provide the following information for the financial year ended 31st December. What was the total of the subscription? Okay, we open the subsequent account. 1st Jan, subscription pay in advance. Pay in advance is the liability, which is that we owing member. Subsequent outstanding means that this is our asset. Balance CD is in here. Okay. Subscription received during the year. Bank receive money, subscription account giving out the money. So which is in credit side. So this 3 item is in the credit side. The question is that what was the total subscription related to the year ended? This is talking about income and expenditure. Income and expenditure is sitting here. This is the amount that you need to find. You add all the items. So 200 plus 68, 200 plus 8800 plus 450. So the answer should be donkey. Okay, total. Okay, next is that 24. The work in progress of ZP manufacturer on 1st Jan was valued at 6,200. At the end of the year, it was valued at 5,400. What was the effect on the cost of production for the year? WIP, this is the beginning of the year. At the end, it was valued at this balance CD. Under our cost of production, the first section is a prime cost. And then factory overhead. And then WIP. WIP, we have opening inventory, closing inventory. This one had to minus. So opening is 6200. Closing is 5400. So the differences is positive. Okay, means that your cost of production will increase by 800. So increase by 800. Okay. Now next sum. A manufacturing company provide the following information. What is the cost? So you notice that sounds that this all we did just now. Okay, the MCQ sometimes they will mix, rearrange the question, change a little bit here and there for the weight variant. Okay, here cost of sales is how much? We take. Let me see what is the information. This is manufacturing cost of production, finished good. Purchase of it. Okay, we start from the raw material. Raw material we have no need. Here they ask for cost of sales. Okay, cost of sales is opening inventory plus cost of production plus purchases minus closing inventory. So our finished good is 42000. And then our cost of production is 345000. Purchases for the finished good is 15,000. Okay, then the closing inventory is 36,000. So we calculate the cost of sales. 42000 plus 34500 and then plus 15,000 minus 36,000. So we get balance 36600. So the answer should be donkey. Okay, now next. Okay, 26. Tahir provide the following information for the first year of trading. So Tahir gross profit margin. This is sounds like repeated. Sales minus sales return 17000 minus 6,000. So we get the net is 164. Okay. And then our cost of sales. Our cost of sales, because this is the first year, opening inventory is 0. Purchases is 129000. And then closing inventory, we don't know. Okay, so we get gross profit. Gross profit margin. So this one 25%. This one will be 100%. Okay, the formula is that gross profit margin divided by the revenue. So this is 100%. So this one automatically is 75%. So we get this one out first. We take 164000 divided by 100 times 75. So we get 164000 divide 100 times 75. So we get the cost of sales is 12300. Now using this information, this one is 0 plus 12900 plus minus closing inventory. This minus you bring it to here, this one bring it to here, become 12900 minus 12300. So we get the closing inventory. So the answer should be 6,000. Okay, the next finish up this paper first. 27. A business provide the following information. Opening inventory, closing inventory, rate of inventory turnover. What is the purchases? Okay, we calculate the cost of sales first. So the formula for rate of inventory turnover is that cost of sales over average inventory. So which is 6 times. The cost of sales we don't know, but average inventory is 6,008 plus 6,000 divided by 2. So I get cost of sales divide 6,008 plus 6,000 divided by 2. So I get this one 6400 equals 6. So my cost of sales equal to this one go to there times 6, 38,400. So this is the cost of sales. So I take opening inventory 6,008 plus the purchases minus closing inventory equal 38400. So I bring this inventory to there. So purchases equal to 38400 minus 6800 plus 6,000. So this all add up plus 6,000 minus. So we get 37600. So this amount we got. Where is my mistake? Cannot get it. Where is my mistake? Let me count out. Let me check one more time. Where is the mistake? Cost divide. This is a 6. Sorry, this is 5 times, not 6 times. I saw wrongly. 5. Okay, so this one will change. 6,004 times 5. So this is 32,000. So this one 32,000. 32,000. So in this case, 32 minus 68 plus 6,000. So we get 31200. So the answer should be 312. Answer B is a 5 times. Okay, now next is page 31. John rate of inventory turnover is 10 times in the year 1 and 8 times in year 2. Year 1, year 2. Rate of inventory turnover 10 and 8. Okay. When talk about the formula, cost of sales divided by the average inventory. In order, rate of inventory turnover is talking about you buy, you sell, you buy, you sell. More is better. That means your turning of the goods to generate the income is faster. So more is better. So year 1, 10 times is better than year 2. Next, which may not cause the change in the rate of inventory turnover. Now look at this for information. Cost of sales actually is that the purchase price times the quantity of the purchase. So this price is not give the quantity will not give the impact because this quantity is according to the sales quantity. The match with the sales quantity. Purchase quantity match to the sales quantity. What you sold? This is a good sold. Good sold. So this quantity should be same to the sales quantity. So there is no effect on the quantity. But this one, purchase price will give impact on this one. When your purchase price increase, okay, this turnover will be increased. Okay, because formula saying that this one is on top, so this one by right should be increased. Whereas this one, average inventory turnover, the inventory, this is referred to the holding level. So when this one increase, inventory turnover will be decreased. But when the inventory hold is decreased, this one will be increased. So from this information that which may cause the change in the rate of inventory turnover. Here, lower inventory low level. This one inventory is referred to this one, the C. Okay. And then selling price, nothing to do because this is a cost price. Get it? So only one choice, that means answer should be C. Okay, next. Okay. Question 32. Maya have annual revenue 100,000. In year 1, her gross profit margin 45 and her profit margin was 5. Okay, we put in the information year 1 and year 2. Okay. And gross profit margin 45% and 5%. Oh, sorry. Profit margin is 5%. Year 2, 40% and 3%. And the differences between these two is the expenses over the revenue. So 45 minus the expenses, you get the 5. So basically your percentage for the expenses over revenue is 40%. Whereas this one is 40 minus 3 is 37%. So come to this comparison, they say that what happened to Maya cost of sales and expenses in year? Cost of sales is talking about the gross profit margin. This amount has reduced, so decrease. Should be increased because this one GP has decreased. This one decreased. When this decreased because gross profit got two components, revenue and cost of sales. This one decrease means that revenue decrease, cost of sales increase. The two possible reasons for this one. So in this case, cost of sales should be increased, not decrease. Whereas expenses, how we see the expenses? Take these differences, you get 40. This one you get 37. So second year, from 40 to 37, that means it's decreasing. So the amount decrease. So the answer should be C. Okay. The 34. Revenue should only be regarded as earned when the legal title of the goods and service pass from the seller to the buyer. In which accounting principle does the statement refer? This is talking about realization. Okay, I just use this here to explain what is the accounting principle for each. Going concern, assuming the business forever, operate forever. Matching concept is talking about the cost or the expenses incurred matched to the revenue earned. Money measurement is talking about the recording in the accounting must have the value for the recording. We cannot, based on the assumption or personal opinion, to do the recording. Must based on a document, must have the value for the recording. Realization is talking about when we want to recognize the sales, when we want to recognize the inventory. Okay, let's move on. The last one. The last one. Okay. The information provided in the financial is independently verified. Okay. Independent means that can be trust. Okay. Can be trust, free from the error and bias. So that is a reliability. Comparability means that the information is we have the in so-called, how to say, comparability means from year to year, we can compare the data. We know where is the differences, where is the similarity. That's called comparability. Relevance means that the information provided in the financial statement able to make the decision. So this keyword decision making for the relevant, the information. Reliability, normally we have free from the error and bias. So free from the error and bias, which is the independent verified. Understandability means that understand by the user. How we want to make sure understand by the user? We follow the international accounting standard for our preparation for the financial statement. So that's all for today. Okay, we don't